In this video, you will review the tax implications of business succession to keep in mind as you plan for the sale of your business. Business succession planning. Personal and corporate goals. Review current state of the business. Estate planning. Evaluate value of the business. Contingency planning. Develop exit strategy. Execute sale. Wealth management. Business succession planning should involve planning to minimize capital gains, estate, and other taxes for the current owner and other family members. A tax specialist has the expertise needed to advise business owners on the important tax issues that will arise during the succession planning process. Hiring a chartered accountant that you trust and work well with is imperative. Your financial advisor may provide broad-based financial planning or specialize in insurance. Life insurance and critical illness insurance can help ensure that funds are available to carry out a succession plan, especially when triggered by a premature death or diagnosis of a critical illness. Consider a financial advisor who has their Certified Financial Planner, CFP, designation, or an insurance specialist who has had their Chartered Life Underwriter, CLU, designation. Tax planning. Tax planning involves more than simply minimizing the taxes that you and your business pay on an ongoing basis. The tax planning process is designed to accomplish many goals, such as taking full advantage of any tax exemptions available to you and other shareholders when you sell your business, deferring tax liabilities from one generation to the next, reducing any probate fees that may be charged to your estate upon death, structuring your estate to minimize the tax liability and help ensure that funds are available to cover this liability. Timelines. You may not be considering retiring quite yet, but the sooner you start thinking about succession planning, the better. It can take several years to implement a plan that minimizes your tax liability. Why does it take so long? There's a lot that needs to be dealt with. Preparation of succession, transfer of ownership, leadership, and control of your business, adequate retirement after sale income, minimizing income taxes. Capital gains deduction. Ask your advisor if you qualify for the capital gains deduction. The current lifetime capital gains exemption, or LCGE, limit is $971,190 as of 2023. If you are in a partnership, this amount would be able to be used by each of the partners. As a reminder, attention to tax consequences can save you and your family a considerable amount of money in the future. Ensure that you and your advisors thoroughly consider any tax issues during the succession planning process. Business succession takes a lot of pre-planning, not just internally, but with your external partners such as your lawyer, accountant, and financial consultant. These experts will be able to guide you towards the most seamless, cost-efficient plan and provide you with accurate advice that you will require to make informed decisions.
I'm Melissa McLean, accredited financial planner with IG Wealth Management, and here today to talk about some tax considerations for selling your business is Adam Shaw, CPA. Adam, thanks so much for joining me today. I want to go through a few questions, but first tell me a little bit about yourself and your experience.
Well, thank you for having me, Melissa. I've been a CPA close to 25 years now, about 8 years working for a regional firm and close to 20 years on my own. Came out of Wilfrid Laurier initially. I have a background that is kind of varied. We cast a pretty wide net with our little firm, with everything from farms to truckers to industry to golf courses. So a pretty varied experience in our little community.
I want you to tell us, when should you be consulting an accountant when you're looking at selling your business?
We usually say right away, please. The time that we can help with the process, the time that we can help shape how you do things is from the beginning. The decisions you make at the beginning of a sales process decides the timing of your compensation, the tax you pay, and how it's structured. So we really like to be in on the front end if we can.
Right, and that provides those sellers with some really great guidance. And also, if you're purchasing a business, I guess it would be the same thing, is to get you involved right away. So
Sure.
Great. What considerations should be given when looking at selling your business under the different structures? So such as selling an incorporated business, partnership, or sole proprietorship?
A lot of considerations are kind of across the spectrum, whether you're selling a corporation or a proprietorship or a partnership. The obvious answer is, well, how much money can I make? But that's not always the only consideration. It's the timing of what you get paid and what you want to see out of the process for yourself, for the buyer, especially if that buyer is your children. So it's a process that really has to consider a lot of variables for what your needs are, and your family, and even your business's needs.
And so then, just to kind of add on to that, would it also be something to take into consideration the timing? So different businesses might have different year ends. Would that impact when selling your business should occur?
That can certainly have an impact on the decisions for your business. Corporations have different options as to whether they're selling shares or whether they're selling assets. Proprietorships and partnerships also have similar considerations when they're selling their interest. Timing can be a big consideration depending on the income and the style of the business.
And what types of businesses can leverage the capital gains exemption?
Well, what we have is every Canadian-controlled private corporation is entitled to a capital gains exemption amount, and right now that's over $900,000 worth of capital gain exemption that every Canadian individual can have. There's certain requirements that you have to go through to make sure that corporation is ready for that sale, getting out redundant assets and stuff like that. But that's kind of fine details. So every owner of a small corporation in Canada has that exemption available to them for every shareholder. So oftentimes, if there's multiple shareholders, there's multiple times that. I believe it's now up to $971,000 worth of capital gain exemption that are available to the shareholders. Now, aside from corporations, family-run farms, whether they be proprietorships or partnerships, also have an exemption, and it's at this point at a $1 million exemption. So they have that available to them as well. So there's a lot of options as long as you've got time to put them into place.
Now, when it comes to partnerships and that capital gains exemption amount, does each partner receive that capital gains exemption?
Now, unfortunately, in a proprietorship or a partnership that does not involve a farm, they do not have that exemption. So depending on the value of the business and what your aims are, you may consider, some businesses consider incorporation for that consideration alone, the ability to take advantage of that exemption.
So when the business succession is going to family, talk to me about some of the tax strategies that could be utilized there.
Well, there's a number of ways in which the equity or the value of a business can be transferred to a child in a way that takes some of the pressure off of them and some of the tax consequences off of a seller. There is what they call a capital gains reserve. So if you are selling a business to a child and they are unable to pay the whole amount up front, that if you are staggering or delaying part of that payment for a period of time, you can also stagger and defer the payment of the taxes on that gain. So in the case of a small farm business, that deferral or that capital gain reserve can be taken over 10 years. And even in an arm's length situation, that can be spread over as much as 5 years to give a bit of an advantage to anyone who's trying to give a buyer a bit of a leg up. Now there's consequences to both, but that gain can be spread over a period of time.
What would be some of those big consequences that you were referring to? You don't have to go into all the details, but some of the big ones.
Well, oftentimes when someone's selling a business, they're getting close to retirement age or they're approaching 65, and there is old age security that they'll be eligible for. But old age security can be clawed back if your income becomes too high. So the sale of a business could have qualifying income that takes that old age security away from you. Now, it may sound like a good idea to spread your proceeds over, 5 or even 10 years to try and avoid what they call the clawback of that old age security. But you may find that it's a bit like a Band-Aid. You rip it off fast and you get the clawback once, whereas if the proceeds are high enough, then you could have it clawed back 5 different times if you're spreading your gain over that time. So the calculation itself becomes pretty important.
Tell us about some of the payment structures that can occur for sellers.
Well, we already talked a little bit about when you sell the shares of a corporation, that you can get that up to $971,000 capital gain tax free. But oftentimes a buyer would rather buy the assets of your company as opposed to the shares. So that becomes a bit different of a structure in that if you're selling your assets, you're selling your goodwill, you're selling, the possessions of the business, then that becomes a taxable event for the corporation that's doing the selling, and then it becomes a taxable event again when those proceeds land in the hand of the owner. So some of the pricing and some of the timing can be affected by the structure of the transaction itself.
Is there any big advantages or disadvantages as far as some of those structures to really say, ooh, this one may be a little bit more advantageous? I guess in some ways it would all be very custom with the business that is being sold.
Yeah, when you're a business owner, you'd really like to sell shares if
Right.
people had worked with you, because that becomes a very clean break for you, because now they're taking over the liabilities and the assets of the business. So you've essentially marked a date at which you are no longer responsible for the business, and a lot of your proceeds can be tax free. As a buyer, you don't necessarily want to be talked into that, because for the same reason you are now taking over the responsibilities and the potential liabilities of the business itself. So the legal work of the deals becomes more complicated because you have to indemnify the purchaser from all responsibilities before a certain date. But oftentimes a purchaser could be interested in some of the licensing and some of the rights that company has. So sometimes it's a good fit. Sometimes it can work for both parties.
Right. So another good reason why to get the experts involved right away, to be able to guide you along to what would be best for them as sellers and the most tax efficient. So yourself and a lawyer should be somebody that they inquire with, fairly soon into the process and not sign any kind of documentation.
Yeah, we realize our time isn't cheap, and we understand the costs involved, but this is very much where an accountant and a lawyer can be really worth their money, in that they help you make sure what you intend to happen actually happens, and that there's no surprises along.
Is there a way to avoid the OAS clawback after the sale of the business? I know that we kind of already touched on the old age security, but is there a way to kind of avoid having any kind of clawback?
Sometimes. The answer is always it depends, right? Sometimes it depends on the amount. Sometimes it depends on the situation. Sometimes we're lucky enough that we say, okay, well, here, if if two spouses own a business together and the proceeds are spread over a number of years, as long as their annual proceeds don't exceed the OAS clawback threshold, which I believe is just under $82,000 this year, then sometimes you can avoid that in its entirety. If you can't, you're always best off to try and take the whole hit in 1 year and then reestablish your OAS in subsequent years. So depending on proceeds, sometimes it can, but if you're getting enough, there's a hit to take. It's just a matter of when and how you do it.
So talk to me about what the alternative minimum tax is.
Well, accountants don't generally like this one, but it is kind of an unusual tax meant to catch any income that is not taxed under any other measure. So if you receive any more than $40,000 worth of proceeds or $40,000 worth of income in any 1 year that hasn't been applied for tax in any other way, it becomes potentially liable for alternative minimum tax. Now, there's a lot of exemptions and there's a lot of outs, and it's kind of a complicated road. And even if you look like you're on the hook for alternative minimum tax, there are ways to mitigate that. When you buy RSPs, you are lowering your income for alternative minimum tax purposes. But it's a 15% tax that has the potential to be levied on proceeds in excess of $40,000 that haven't been taxed any other way. So now they are refundable amounts. So if you are on the hook for alternative minimum tax in any one given year, it can be recovered in subsequent years by being applied against other earned income. Now, that can be a catch if you're selling your business with the consideration that your working days are done. But if you're going to be working in some capacity in some other way, oftentimes that tax can be recovered as an offset to taxes you'd otherwise owe in future years. So it's unusual, it's sometimes unpredictable, but we always try and keep it in mind when we're making our plans.
Anything else that you feel would be pertinent information for our viewers to know and understand when selling a business?
The discussions have to be very frank, especially in some kind of succession plan. It's important to talk about larger issues, about what you want from your life, what you want from your retirement, because a lot of your decisions can be shaped by that. And there's a lot of flexibility. There's a lot of things that can be done to mitigate consequences of any decision. So being honest and being thorough and trying to hear everyone. There's a lot of tax specialists that make their living on almost being pseudo counselors, in that the first discussion is, well, what do you want as dad? What do you want as the daughter? How do we protect assets? How do we protect everyone's seat at the table? How do we adjust the decision-making responsibilities? And there are ways to do that. If a parent is looking to pass on responsibility and ownership to a child, then that can be done gradually. And there are succession plans that involve what they call estate freezes, where the value of a business at a certain point is stored in a certain set of shares that the child's going to be buying over a period of years or redeeming with business funds over a number of years, and slowly gaining the votes and the authority with it. So there's a lot of good transition measures that can be taken. It's probably a little bit long-winded, but being clear on what everybody wants and finding that consensus before you even really talk about dollars is really important.